Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel. And today we have an amazing guest in Mr. James Cook, the National Director of Brokerage at Yale Realty Capital Advisors. Before we dive in, I want to ask you a real quick favor. Would you mind taking an extra 30 seconds and heading over to iTunes to rate this podcast with 5 stars? This helps us get more listeners, and it means the absolute world to me. So thanks for making my day with that review of the show. All right, let's dive in. James's primary focus at Yale Realty Capital Advisors is assisting buyers and sellers of quality manufactured home communities and RV resorts. Yale handles everything from confidential displacements to running full marketing and the call for offers process. Yale focuses on institutional grade communities ranging from 50 to 1,000 plus site portfolios. Having successfully closed on the sale or financing of roughly $1 billion in production, it would be hard pressed to find a more experienced or capable broker in this niche asset class. James, welcome to the show.
Andrew, good to be on the show. And I've rarely heard voices that belong more on the radio than mine. So good job, man. Now I know why you got in the podcast business.
Oh, man, I love it. Thank you for that. James, would you mind starting out by telling us your story and how you got into manufactured housing communities?
Yeah, I think like you, started out in residential briefly as a fresh licensee, got encouraged to get into real estate by my best friend's dad, who was a successful developer and residential agent when I was really young. He talked us both into getting our licenses at 18 and was still running a family business at the time. And I think I realized early on, I didn't want to be in the residential business. It was a little more of an emotional business. It was, it did fine in it, but realized it was a lot of just kind of emotion and didn't seem to have a lot of rationale why people did certain things in the residential world. And I've always been an investment and very interested in investments and numbers and just enjoy the math side of the business and returns and things like that. So that's, I think, originally why I started looking around at investment real estate. Ultimately ran across a owner in my hometown where I grew up in North Florida who had a mid-sized manufactured home community. I took at that time was like a pocket listing. I put it on, I think, an early version of LoopNet, and my phone rang off the hook. And I said, okay, this is an industry where there's a lot of investors looking to get in, and there's a need to go out there and find more of these community owners that are looking to sell. And so at about 21, I went full time into just brokering manufactured home communities.
Wow. And when was that first listing, that first mobile home park listing?
2005.
2005. Wow.
Yeah. And I don't know what it was. I think it was an early version of LoopNet, but my phone rang off the hook. And back then we were in a scrappy business, as you might imagine. I mean, you didn't have all the big funds, and this was a decent size, what became an institutional size asset at the time. When I would call the big operators in 2006 and 7 and 8, they didn't want to touch anything below 250 spaces. And now, they're happy to buy a 100 space park in a good location. So, at the time I was dealing with a lot of smaller mom and pop investors, and people were specifically looking to buy mobile home parks because they could get special terms, owner financing. It wasn't as competitive. And much like it is today, was less competitive than multifamily, but we've came a long ways. There's a whole different profile of buyers, and we could talk about that at some point. But I'll let you kind of stick with your questions.
Yeah, that's awesome. Maybe you can tell us about Yale. I know you have a big team on the capital side as well. Maybe just introduce us a little bit.
Of course, yeah. So somewhere in 2008, when the market started correcting with the great financial crisis, and I guess the residential mortgage bubble popped, I started noticing that financing was really the tail that wagged the dog. If you didn't have financing, you didn't have a deal. And owner financing is great, but a lot of the sellers want to cash out. And their thoughts are they're going to run it as long as they can run it, and if they sell, they don't want to have any contingent liabilities with the property. They don't want to worry about what happens to it after they sell. And so at that point, I actually asked my assistant to start calling banks, and we started compiling banks that would do this, that would finance these. It went well. I learned about agency financing. I did some agency financing at the time. Found a couple balance sheet lenders that liked this space, and we kind of sold a couple of banks in the space. And that was what was facilitating deals 2008, 2009, 2010. And I had a couple pocket buyers that had deep pockets, and a couple of really close clients that had deep pockets, credit facilities still. GE was still running a credit facility at the time, which was very productive. And around 2012, moved down to Miami, met Chris San Jose. Early on in that, I guess late 2011, I moved down here. Met Chris San Jose, who was a fresh grad from with a real estate and finance double major. Hired him, and we quickly realized that he would just be a really good fit for that side of the business. So he's since built that business. I know he's financed a couple hundred parks himself now. And I know his financing volume has been in excess of $1 billion. And then we, around 2014 or 15, we started layering in regional directors, because at the time I was still, servicing primarily Florida, and I would get calls from guys to fly out to Arizona and work on a deal, or fly to New York and go work on a deal. And so, I realized that there's just such a need for specialization, not only in the asset class, but in the region, because you have different states with different laws, you have, different operators and different kind of regional players that it was impossible for one person to kind of know all the major players. So, fast forward to 2022, we've just hired our 11th regional director. So we've got somebody actually covering the New England market, specifically, New Hampshire, Maine, Rhode Island, Connecticut. And, we think we've got the rest of the country covered with 10 other directors, including myself down in Florida still. And I know we closed deals. I have to look, we probably closed deals in, over 30 states last year between the brokerage and financing division. I think we financed and sold about 115 parks, right around 15,000 sites last year.
That's amazing. And I get your marketing emails, and I see you guys selling stuff at like 3.5 caps. So maybe let's just talk about the elephant in the room here. I mean, how are these buyers right now able to pay some of the pricing they're able to pay? And, where do you see that going into the foreseeable future?
Sure. Good question. I think we're all wondering, where cap rates are going to go with interest rates, almost doubling. It's a good question. We were borrowing in the threes, and now, I haven't got a rate check with Chris in a couple of days, but I got to imagine your best possible financing is going to be in the mid fours, and your par financing from a 3-star kind of smaller deal is going to probably be in the upper 4s to 5% range. So it'll be interesting to see kind of where it shakes out. One thing that we've all benefited from, across really the whole country, has been the lack of housing. As it was in a presentation recently that Blackstone did, and they brought up the fact that America's 5 million homes undersupplied. And so we've got this kind of, you got two factors that are colliding. You've got a rising cost of capital, but you've still got a severe undersupply of housing. And we've been benefiting from it without really processing kind of where all that was coming from. Owners have been getting away with extraordinary rent increases the last, probably, really ever since COVID. We were in that fetal position for the first 6 months of COVID. And then I think by the end of 2021, it became very clear there was a mass migration out of inner cities and out of apartment, complexes to detached housing. Manufactured housing fit into that. And I don't care if you were in Ohio or you were in California or Florida, you just saw a massive increase in demand. So any states that weren't rent controlled were getting away with pretty large rent increases. I think the norm was all of a sudden 7, 8, 9, 10%. And you do that a couple of years in a row, and it looks really good, especially if you can continue to borrow at 3% or 3.5%. So, we all should have expected that party was going to end at some point. And, I think we're now paying a little more, fair cost for capital. I'm a little worried they're going to overshoot. I'm worried that rates are going to get too high, and then I think they're going to come back down at some point once they slow the machine down a little bit. So we'll kind of muddle, we'll kind of see where that goes. But realistically, I'm actually worried that the mid-size investor is going to be the one that gets hurt the worst, because I believe from everything we're seeing, the institutional investor is going to keep moving, because they've got trillions of dollars stacked up on the sidelines, and that money's got to be placed, and they're going to kind of look through the storm and say, okay, this is going to shake out, and we're going to continue to have an undersupply of housing, and rents are going to continue to go up. And so it looks like, as of right now, that money's going to keep, plowing into the space. Will these 3 cap deals keep happening on these, or sub 3 cap deals? Maybe those will slow up a little bit, but I think that for the middle of America deal, if you're buying in the kind of 4 to 6 range and you are finding value and you're finding areas to lease up spaces and improve the community and raise rents, even on turnover, I think that those deals are going to continue to happen, and investors like you are going to continue to do well with those over the long run because we're going to see cost of housing is going to increase and therefore rents are going to increase.
Yeah, no, that's a good point. Could you speak a little bit on 2008 to 2011 during the Great Recession? What did the mobile home park industry look like at that time, and what were some of the negative effects that were felt in manufactured housing?
Manufactured housing suffered its own crisis, which was the chattel lending crisis, about the time I got in the space. So there was a couple of things. You had a fair amount of foreclosures of mobile homes going on before really the great financial crisis. At one point, you had people handing out all this lending to people or you had lenders handing out all this lending to consumers to buy mobile homes. And so you had a bunch of homes bought by people who couldn't afford them. And chattel lending kind of blew up before the great financial crisis. So when I got into space, especially in kind of the middle of the country, you had a fair amount of vacancy. You had homes you could buy from the lenders for a good price. And, guys were even still poaching, buying homes out of people's parks, pulling them into their park. It was kind of a scrappier business. But somewhere around 2009, 2010, we kind of caught our footing, and this industry just really took off. If you looked at it, I think there was, 2007, 2008, when I first started the business, we had maybe you could count on one hand the number of real institutional funds in the space. Today, there's somewhere between 80 and 100 that have over $1 billion of assets under management. And some of these groups literally have hundreds of millions or even billions available to invest in the space. So we've went from 5 to probably nearly 100 funds investing in the space. And from the consumer standpoint, today, almost every manufactured home community in any viable market ran by a competent operator is well occupied. The biggest challenge owners have is they can sell homes the day they get them. It's either finding used homes and finding the labor to fix those up and then getting them ready to sell, or it's the fact that the supply chain is so messed up that you can't get a new home for almost a year. So I think those are the challenges that we're seeing today. Back then, you had some vacancy. Rents for the homes are lower, prices for the homes are lower. And we were having to owner finance homes. And somewhere in I guess when the Obama administration came in, then they tried to ban owner financing essentially. So we had to owners either had to get some additional licensing or hire a third party mortgage servicer to handle those, or do rent to own and some different techniques to work around that. So, I guess we've been through a lot of different challenges, but in the end, our industry has always seen steady growth. I remember looking at financials from 07 to 08, and we really didn't see a drop. And then 08 to 09, we would see, growth. And 09 to 10, we kept seeing growth on people's P&Ls, year over year. It was just different challenges, whether it was finding homes, whether it was, buying foreclosed homes, fixing them up, and the problems kind of move around, but the industry has always been steady and stable, and I think a safe place to invest.
Yeah, no, that's great feedback there. What do you feel is like the best opportunity or strategy right now for operators in the space to create a good return on investment for people?
I think again, there's 2 programs. There's the groups that are just aggregating assets. Really, folks like you have probably bought and fixed up, and they're going to roll those up into portfolios, continue to find economies of scale, continue to raise rents, and then probably sell those off in a larger portfolio or to a REIT or to a major fund that might want to go public. And so you kind of, just like any other business, you have different folks in different stages of the cycle. If you're kind of buying that $1 to $10 million range, you're really buying off of your typically your mom and pop again, or maybe an aggregator that bought an asset that's not in their wheelhouse. They bought it either in a portfolio or it's not near their kind of their core base, or it's too far away for some reason. And so you're going to follow up on somebody who has not maximized occupancy, who has not improved these communities, and it's the old business model of find a community that's under maintained, under rented. Usually the majority even of our sales, even still today, are for longtime owners. And I think there's kind of that almost like a curve of you get in the business, you build the thing, you're interested in it. And then as that investor ages, maybe they build it in their 40s or 50s. And then when they hit their 60s or 70s, they've got other interests in life. They want to go, spend more time with their family or travel or semi-retire, and maybe the kids aren't involved yet. And so their interest wanes. They're not keeping rents at market. They're not maintaining the community, and they're letting some vacancy creep in. And those are the opportunities that I think, aggregators can find and improve and find some economies of scale and do well with individually. And then, of course, like we talked about, if you assemble a few of those, you get inherent cap rate compression.
And maybe touch on that a little bit. You mentioned like a portfolio and aggregating a portfolio. Maybe touch on the benefit and how much lower of a cap rate operators could expect aggregating a portfolio and maybe what matters most, right? Is it a location play, having economies of scale in a certain market, or is it having similar quality? Is that important when aggregating a portfolio, or is it size, right? Like if you have, a bunch of 30 lot mobile home parks, is that obviously not going to be as valuable as a bunch of 100+ lot mobile home parks?
Right. What I found in this business is unfortunately, there's no rules that stick. There's a portfolio that's selling right now in the Midwest, and it's a bunch of 50 and 60 space parks. Now they're mostly in one state. And for a long time, that was kind of thought of as non-institutional, and it's trading to an institutional player. So again, when I got in the business in 2005, and then full-time in 2007, we had, the rule was you had to be over 200 spaces. And then it went to 150. I think it went 250, 200, 150, 100. And now we're down to, frankly, there's been a lot of consolidation in 50 space communities. I don't know where where we just stop and just say, look, it doesn't make sense to own communities below this certain size if you're at all an institutional investor. But, in a perfect world, you're building a portfolio of probably 1,000 spaces in a region. And that region could be the Southeast, it could be the Mid-Atlantic, it could be the Northeast, any region of the country. But I think 1,000 spaces really gets a lot of attention. And obviously, the closer it gets in proximity to each other, and the larger the individual assets are, the lower that cap rate's going to go. But, along the way, when you're acquiring those, again, if you're buying them off that typical 40-year hold, first generation aged out or second generation inherited it, you're immediately walking into usually 10 to 15 to 20% rent growth off the bat, within 2 or 3 years that can be accessed. I would say the norm, maybe closer to 20 to 30%. Then you're walking into some economies of scale that you should have between multiple assets. You're walking into some vacancy that you can fix over time. So you're getting those operational, improvements automatically. So even if your acquisition cap rate was a 5 and your exit cap rate was a 5, you'd still make money. But what we've seen traditionally is you could probably answer the question better than me, what you've kind of seen in your, acquisitions, but you're probably acquiring mostly, in that 4.5 to 6.5 cap range, depending on where it is, region, quality, size, all that. And then as a portfolio, we've seen most of these portfolios of kind of 3-star assets trade down to around the 4 cap range. If you're talking about 500 spaces or greater, preferably 1,000, and there are outlier deals that are trading in the 3s, and there are outlier deals that have traded in the 2s, just depending on the story. But I think, for the majority of the people on this call or that are going to be watching this, you're going to be talking about kind of 100 to 100, or 75 to 150 space assets, single wide assets, in kind of tier 2, tier 3 cities. Those are going to, you're going to buy them and probably get 100 to 150 basis point, cap rate compression on the exit if you aggregate, 1,000 spaces.
Yeah, that's awesome. That was my ballpark. So that was good to confirm that. James, this is something I ask all my guests. What are the most important things that passive investors, we're talking limited partners here, what do you think are the most important things they need to look out for when investing into mobile home parks?
I'm an investor in maybe 30 to 35 LPs, multifamily, manufactured housing, and RV. And, obviously the number one thing is the operator, and so I think it comes down to investing with a competent operator with a competent business plan. I think one thing that I always liked, Andrew, when I heard your story about you going to live in a community and learning the business from that side, I've had people, really my entire career saying, "Oh, we'll just throw a bunch of money at you. Why don't you go buy all these assets and operate them?" My approach was, I want to learn this business. I want to be in the brokerage side for a long time. I'm not in a rush to compete with my clients. I've had the opportunity to invest in deals with folks, had the opportunity to buy a couple deals on my own, or with a limited group of partners that we just didn't feel like we were competing. The seller didn't want to list it, didn't want us to represent them, and was reasonable on pricing. And it was just too obvious or easy to pass up. But in general, I'm scared of that side of the business because it's operation intensive and you need to be full-time focused on it. And I think that, so you got to pick a partner that has the team to execute that business model. And then, you want to be investing with people with ethics. And, at the end of the day, they got to be, decent operators, good operators, and they got to be just good overall people with a track record that you're comfortable. You're not gonna have to chase your money, because in this business, it's mostly basically reputation, credit is what you're running on. I mean, you've got a share of a deal, but thankfully, across the probably 40 deals I've invested in from end to end, we've never had anybody run off with our money or mishandle our money. We've made, very little money in some deals. We've made incredibly strong returns on other deals. So I think it's obvious. You want to look at the operator's track record. You want to look at kind of their, you want to get a synopsis of their last maybe 3 or 4 full cycle deals, if they've had some, and find out what their acquisition price was, what the exit was, what those investors made in that hold, kind of what the return was. And I think you just set your expectation that, you're going to average somewhere around your pref return plus a few percent, and be pleasantly surprised if it ends up being, kind of mid-teens to low 20s on an exit. Either which way, if you're making over 5%, you're beating anything you can do, pretty much in the passive world. So if you're investing with a good operator, a good honest group, you're going to be pretty happy with this industry overall.
That's great feedback. James, what does the perfect mobile home park look like in your eyes, and why?
I've always said every deal's got some amount of here. If it's not the property, it's probably the owner or the financials or the government. There's always some here on it. There's got to be a universal, there's the hot, crazy matrix. There's got to be one for parks. If it's too good of a deal, there's a problem. Resident-owned homes are ideal. Be in an area with at least, steady economic underlying fundamentals. I think large enough lots to facilitate, at least, 66-foot homes or greater, at least, 14 wides, but ideally 16 wides to get modern, 3-bedroom, 2-bath homes in there. Those are things that we look for. But again, there's a million exceptions. If it's an urban infill location in, Orlando, Miami, Tampa, you're in a major MSA anywhere in the country. I don't care if you're in, Albany, New York, or you're in, St. Louis, Missouri, you could definitely fill a park with older homes because it's all about convenience, and you can gear that towards seniors. But in general, larger lots that could fit, modern, at least single wides, off-street parking. We're never lucky enough to get those deals that we invest in, it seems like, but city utilities are great. I'm not afraid of private utilities. In fact, often, you can provide private utilities for $10 a lot, and you're getting really $50 of value in your rent out of it. Water and sewer has a $50 retail value, maybe 60, maybe 70, maybe 80, maybe 90 in some major cities. And I've, a well-ran treatment plan and well, that's checked out and diligenced properly by a good operator like yourself is a good play. But, in a perfect world, again, if you're asking me for my Christmas wish list, give me city utilities, give me, hopefully they're not metered yet, and I can just throw a meter on them and get that expense passed off to the resident and free up some capital that way, get my NOI up. And then, ideally it's over 100 units, but if your lot rents are strong and it's in a good market, at least 50 units. And, I think the biggest thing that you got to look at when buying these communities, and I know you've learned this the easy way and the hard way, is what's under the ground. It's not what you see that gets you, it's what you don't see. It's the water and sewer lines and the electric infrastructure. Are you talking about terracotta clay that's in really bad shape? Can you reline it? Do you have to replace it? And then some of those old water lines, if they're is it galvanized or copper, they can be problematic. And so I think knowing those things going in, kind of building in for your worst case scenario and your model of oh my gosh, those utility lines run under my streets. And if I'm going
Yeah.
to work on those, I'm going to have to tear up all my streets, replace them all, and then replace my streets. That's a $500,000 to $1.5 million problem on a small park. So those are the things you got to know about. Again, a lot of guys have had dumb luck in this business, and you probably have bought a bunch of communities. I know guys have bought 10, 20, 30 communities and never really had to do a full overhaul, but that can bite you sometimes. Give me if I'm again writing down my Christmas wish list, give me PVC utilities, fully redone, all Schedule 40. Those are ideal things that you'd like to see in a community.
100% agree with you, James. Yeah, I learned the hard way, and I was talking with an LP earlier this week, and I told him every single deal that we've bought, we've learned something and added to our due diligence checklist. So that's the value of an operator that has a track record, right? Because you learn from every single deal.
Well, yeah. So when you were getting in the business, you had the benefit of you're learning, but you're buying at a higher cap rate. So, one of my things I've learned is, sometimes you can actually rule yourself out of deals. It's kind of like, meeting a 50-year-old bachelor who just nobody will ever be good enough for him because he's got so many rules. You can, I don't buy parks with this. I don't buy parks with that. I don't buy parks with this. And I'm like, if I look at your portfolio, you wouldn't have acquired anything you own and wouldn't have made anything you've made, based on your stiff criteria. So you have to pretty much go in with the mindset that everything has a value, and I'm willing to buy almost any situation, but it just has to be price adjusted. So perfect park, all the boxes checked. I'm going to be paying a cap rate that's going to look like the interest rates, maybe even a little lower if there's room to remove the rents. And then as you get away from that, you should get a little bigger yield or just have more upside to compensate for it.
That's a great way to look at it. James, I'm going to cut us off here. We'll go all day, man. I really appreciate you coming on the show. Tons of golden nuggets for our listeners. If anyone would like to get a hold of you or check out Yale Advisors, what's the best way for them to do so?
So our website's just yaleadvisors.com. I think all of our contact information's on there. In general, we try to work with, end park buyers. So if you're looking for a good group to invest with, I'd say do your research. From what I know of Andrew, they do a great job. I've seen them do some great turnarounds, and I would definitely give them my endorsement. If you're looking to buy manufactured home communities, or you own one or 10 and you need to refinance, please reach out to us. If you're looking to, if you have an asset, you want to talk about repositioning it or how you're going to maximize the value, or you're just looking to sell, we'd love to help. Go to yaleadvisors.com. All of our information's there. You got a nifty little map. You can kind of see where everybody's at. And also you're clicking the team. And if you need to, just shoot me an email. My name, James at yaleadvisors.com, and I'll point you in the right direction. Andrew, thanks for having me on the show. Great to catch up, man.
Yeah. Thank you so much for coming on. That's it for today, folks. Thank you so much for tuning in.
Cheers.
Hey, are you getting value out of this show? If so, would you mind please going over to iTunes and leaving the show a quick 5-star review? I have a goal of hitting over 100 5-star reviews by the end of 2021, and it would mean the absolute world to me if you could help contribute to that. Thanks ahead of time for making my day with your 5-star review of the show. Would you like to see mobile home park value add projects in progress? If so, follow us on Instagram at Passive MHP Investing for photos and awesome videos from our recent mobile home park acquisitions. Once again, that's at Passive MHP Investing on Instagram. See you there.